Okay, we now move to a relatively bigger chapter, which is managing and mitigating liquidity risk. So we'll look at some of the topics here, and uh, we'll try to understand how complex stream incorporating asset liability management, and what are the risk concentration, and how do duration and convexity and valuation and regulatory risk affect the entire framework. We'll also look at correlation shift depending on market movement, and uh, and some of the mathematical modeling, but we'll just keep those things at introductory level. So the foundations of corporate strategies are first topic. So we established that liquidity risk are considered as a primary cause of funding risk and one of the catalysts of the financial crisis of 2007-2009. It is important that financial institutions establish a framework that fosters firms' agility, responsiveness, and adaptability to effectively manage uh, and mitigate the risk. Framework should incorporate three components of liquidity management strategy. First is tracking and monitoring risk concentration. Second is valuing and measuring sensitivities. And third is asset liability management. Developing effective corporate strategies and framework first requires that the firm understand their internal risk appetite that makes them vulnerable to risk, consequently identify the factors sensitive to which firms are exposed. With regard to liquidity risk specifically, firms should identify categorize all root risk factors that make them vulnerable to tail risk, that is risk of extreme negative event, and establish a similar process for pledging collateral and contingent exposures like covenant guarantees and options. Once this categorization is complete, firms should aggregate data to identify sensitivities to all root risk factors and highlight the areas where they are exposed to liquidity risk and concentration within or across factor. Identifying the source of vulnerabilities allow for close risk monitoring and allow firms to recompute exposure with different marking methodologies. So the firm should first look at the risk policies, and then the root risk factor identification, then their exposure and concentration. Then they should run all those scenario and understand what could be the impact of liquidity. So risk concentration is the next thing here. So identification of risk concentration is particularly important within the risk management process. Risk concentration causes liquidity issue and increases tail risk dependence. These concentration may arise from natural exposure or can arise for a particular business exposure or maturities. It is prudent that firms may set up flag to identify risk concentration and monitor exposures through various department and process including IT, audit and cash flows. Traditional approaches to risk management focus predominantly on modeling credit risk concentration within portfolio, computing the distribution of credit loss to comply with regulatory requirements like Basel II, portfolio diversification using capital asset pricing model. But the problem with traditional approach is that they cause firm to diversify unsystematic risk and hold portfolio of systematic risk, which expose them to significant tail risk. In contrast with this, the new methodology analyzes portfolio concentration by risk factors, making it possible to reconcile risk concentration across the enterprise. The most prudent approach is therefore to use the new approach in conjunction with the traditional methodology to measure not only specific risks but also to identify what is known as unknown risk concentrations. Liquidity issues surface most often during market turmoils, which cause risk concentration to lead to liquidity imbalances and losses. Firm can manage risk concentration by benchmarking to market segment, countries or system. One issue with benchmarking is the lack of available public benchmark. However, this could be remedied by encouraging industry representatives, professional associations, regulators to make this data publicly available. Concentration can also be managed through quantitative modeling and historical simulation. However, these models easily become unreliable during tail events and period of crisis. So asset liability management, analysis and liquidity management. In order to manage liquidity risk, institution must understand the impact of liquidity concentration on the balance sheet. The impact of liquidity on the balance sheet can be estimated by making cash flows of on an enterprise-wide level. This leads to us to amend the previous simple cash flows and introduce second stream within the framework. The ALM analysis does important as it highlights the effect of changes in risk variables and the vulnerabilities and dependencies in the funding. ALM simulations are also crucial in measuring the performance of internal management and firms' performance margins. In addition, it provides benchmarking for internal and external pricing. Firms typically collect pricing data through fund transfer pricing, or known as FTP, which measures the relative performance of each unit. And FTP provides the framework for a firm to monitor whether risk policies are accurately reflected in the business policies. As an example, a bank's commercial division grant collateralized loan when margins, lending targets, pledged collateral asset depend on risk policies. An ALM approach would reconcile bank margins with the cost of funding and allow firms to implement hedging tactics to manage interest rates and other risks. So this maintains a balance between target returns and acceptable risk by a set of risk limits. All excess exposure should be hedged. So when we look at this in a broader way, we have to take care of the duration and the convexity gaps. A key function of bank risk is to immunize banks' margin against gaps in the value of assets and liabilities due to interest rate changes. A measure of value sensitive to interest rate is duration, where the change is described like change of value of the portfolio upon value of the portfolio is equal to change of interest rate upon interest rate into duration. So the traditional approach of asset liability immunization, however, has several shortfalls. It assumes no volatility in asset prices. It assumes that liquidity risk does not exist. It assumes that the cost of funding is unchanged. But if assumptions don't hold, a change in yield could negatively impact funding costs and create a lot of rising credit spreads, leading to potential disaster consequences, as was the case with Northrop in 2007 and 2008. In response to these issues, firms should maintain adequate ALM process and risk policies to manage both duration gap and interest rate volatility. Duration gap could be controlled by setting up alerts and with respect to valuation risk, where earning alerts would allow firm to adjust duration gap and derivative in a timely manner. Affecting interest rate volatility should be monitored as the impact of firm's liability. Duration and convexity gap analysis should include combined and reciprocal effect of shifts in credit spread, yield movement, and the term structure of interest rate movement. Similarly, convexity is traditionally described through mathematical model but rarely understood in terms of investor emotion. Investor emotion complicate mathematical models based on VaR and net present projection, which are often based on arbitrary caps on interest rate. An empirical approach to the risk management process is therefore preferred, that is based on scenario and expected and experience and less on mathematical model. For example, during 2010 and 2009 crisis, a lack of investor confidence caused an extremely rare of some of the long G7 ball to exhibit convexity. Convexity level should therefore be monitored as gauge of investor sentiments and using alert triggers and incorporate convexity targets. So what we here trying to do is that understand how the firm should incorporate these liquidity risk management tactics and monitor duration, convexity gap into their policies. These are a firm to align fund strategy with corporate strategy and lead to a further improvement in liquidity risk management. Again, one thing here that you should note is that these firms are trying to build and they are focusing on some pre-indicators to find out that there is a liquidity crisis or a concentration coming, so they can find out those points using model, and based on those points they can hedge the risk beforehand. We now move to valuation risk. Modeling valuation risk should be empirically built and maintained. This allows the model to capture complex cross influences including price change under a stress scenario, the impact of path dependent exposure of trading books, change in yield curves, rating matrices, rating shift difference, and changing customer and investor behavior. For example, with respect to trading book, a price movement and volume aggregation provide clues on potential concentration build-up and may higher the degree of market emotion. In addition, before market imbalance or drawdown distortion, including volume imbalances, unexpected changes in correlation and unusual standard deviation are often noticeable. Now, this is a list hint here that we have also talked in that passive strategy session that before the imbalance or drawdown, there is an unusual standard behavior, standard deviation behavior that's noticeable, and that could help the companies hedge down their risk. Direct links between valuation and stress scenarios further improves the price integrity, consistency, and transparency of the framework. So valuation risk also encompasses difference in data management among firms, potentially leading to operational errors and payment disruption. In response, firm could rate the efficiency and resilience of external counterparties and liquidity process. Finally, corporate governance process should be improved through proper incentive and compensation scheme by preparing and training management to adequately react to liquidity risk. Now we move to regulatory risk, and this is the second last topic. The primary criticism of regulatory efforts following the credit risk has been to to bring down the loss, and this has traditionally been done based on assumptions of normality in market, and this normality has been modeled through frequent models and risk weighting capital. However, as the credit risk has shown, these models do not accurately factor the tail risk. As a result, they do not adequately prepare firm to face extreme scenario. In addition, uniform risk tactics across the entire sector may expose the industry to unsystematic risk. In response, a 3-point remedy has been proposed. The first is accessing net exposure quantitatively and dynamically through observable market-based measurement of price sensitivity and liquidity. Benchmarking risk liquidity concentration against the rest of the industry to identify areas of tension and exuberance, providing for worst case development rather than most probable scenarios. So incorporating this regulatory compliance into the liquidity risk management will make it more robust. We now move to the last topic, but again a very important topic, which is liquidity risk and correlation. So in what I have been talking about, that although there are complex and all risk measures cannot be turned into play, we are always monitoring and trying to use some performance objectives, and all risk exposures could be turned into factors and monitored as limit using performance objectives. One exposure that cannot be turned into target is correlation effect within a portfolio or among activity currency region. A correlation are unpredictable by nature and closely related to market liquidity and volatility. So two reasons why correlation could spur off and behave in a strange way is because of liquidity and volatility. And or vice versa, if you think there is a liquidity problem or a volatility problem that's coming into the play, before that you will see some correlation changes, strange behavior, which could help you to mitigate those things. So during normal market events, correlation are driven by market fundamentals, and when market are volatile, correlation are driven by trade events. And for example, during period of market turbulence, market became illiquid, and increased correlation drive entire markets to near bankruptcy, and this happened in Asia in 1997, Russia in 1998, Iceland in 2008. When correlations are unpredictable, risk managers can attempt to identify inflection points, and this is an important term, inflection point, when market regime changes. And again, the regime change has been another important thing that we have been talking about. Analysis during market shocks could include market leverage and funding sources and monitor possible contagion. Correlation can also shift during when market rallies. For example, in commodity market, if the price of gold increases, yet it is still considered risky, investor may switch to silver as correlation between two metals is typically high. When both price reach, correlation may start to diverge. It is important to recognize that correlation movements are asymmetric and will not change the way in up and down market. In other words, empirical evidence suggests that the correlation tend to converge during steady market growth, but diverge during trend reversal or in times of fast downward shift. Sorry, dramatic market rallies may lead to liquidity shock fueled by high leverage. Managers should therefore monitor liquidity concentration and cross assets and cross market correlation during when market rallies in order to anticipate inflection point in the market. In this way, manager could anticipate the correlation effect during asset meltdowns. So all this hints with ultimately help us to build a better funding strategy, and funding strategy involve management liquidity and establish prudent risk management. In terms of liquidity risk, firms should anticipate unexpected events rather than simply rely on model based reporting. This consists of raising awareness, understanding monetary exposure, analyzing risk concentration. Establishing prudent risk management framework relies on continuous exchange of information between firm and regulators and among the regulators. So that was about managing and mitigating risk. And this is an important chapter in terms of again the small video that we were looking at, which was about passive risk management using MATLAB, where we were looking for those inflection points or regime changes or the correlation metrics being changed just before the time of recession or a meltdown. So that was something important. I hope you got something out of this video. Thank you for watching.